The financial media loves a good distraction. They love to talk about the Federal Reserve. They love to argue about interest rates. They love to show you charts of tech stocks and pretend that the entire world revolves around a few square miles in Lower Manhattan. They want you to believe that the price of everything is determined by a guy in a suit sitting at a terminal in New York City. But while the experts were busy arguing about basis points, and while the algorithms were busy trading paper contracts back and forth, something happened on the other side of the world that makes Wall Street look like a lemonade stand. For months, we have been watching the silver market tighten. We saw the premiums rise. We saw the inventories fall. But there was always a missing piece of the puzzle. We knew the metal was leaving the vaults, but we didn't know exactly who was taking it. We thought it might be China. We thought it might be industrial hoarders. Well, the mystery is solved. The whale has surfaced, and it isn't a hedge fund. It isn't a tech company. It isn't even a central bank. It is the nation of India. We have just received trade data that is so staggering, so statistically impossible under normal conditions, that it forces us to rewrite the entire supply and demand model for the precious metals market. According to the latest import figures, India has imported approximately 5.9 billion worth of silver in just the last 4 months. Let's just pause for a second and appreciate the gravity of that number. 5.9 billion in a market as small as silver. That is not an investment. That is a hostile takeover. To put this into perspective, we need to look at the historical averages. From 2013 to 2019, India's silver imports averaged about $1.5 billion for the entire year. They used to buy $1.5 billion in 12 months. Now they have bought nearly $6 billion in 4 months. That is a 400% increase. It is a fourfold explosion in demand. And when you compare it to the peak of 2022, which was already considered a record-breaking year, this current buying spree is 64% higher. This is what we call a step function change. It isn't a gradual increase. It is a vertical line. It is the sound of a country deciding collectively and seemingly overnight that they would rather hold silver than fiat currency. But why does this matter to you sitting in the United States or Europe? Why should you care what happens in Mumbai or New Delhi? You should care because silver is a global asset with a finite supply. There's only so much of it above ground. When one buyer steps in and vacuums up 4 months of global production in a single quarter, that metal is gone. It is removed from the game board. The silver that India is buying isn't coming from Mars. It is coming from the London Bullion Market Association, the LBMA. It is coming from the refiners in Switzerland. It is coming from the warehouses that supply the comics. India is draining the West. And here's the critical detail that the mainstream analysts are missing. They will tell you, oh, it's just jewelry. It's just festivals. It's cultural demand. They want you to believe this is just Indian grandmothers buying anklets. They are wrong. You do not import $6 billion of silver in 4 months just to make jewelry. That volume signals something much deeper. It signals industrial stockpiling and investment panic. We know that India is rapidly modernizing its grid. They are building massive solar parks. They're expanding their electronics manufacturing sector to compete with China. These industries are thirsty for silver. They need it for the photovoltaic cells. They need it for the contacts. The Indian industrialists are smart. They see the same charts we do. They see the mining deficits. They see the geopolitical tensions, and they have decided to front or run the shortage. They are buying the metal now at $90 or $94 because they know that if they wait 6 months, they might not be able to get it at all. This is strategic accumulation. And the financial markets in India are confirming this thesis. Look at the Nifty Metal Index. This is the index that tracks the major metal and mining companies in India. It is having its best start to a year since 2018. The ratio of the metal index to the broader market is at an 11-year high. What does that tell you? It tells you that the smart money in India is rotating out of general stocks and into hard assets. They are selling paper and buying rocks. They are selling promises and buying reality. This is a macro rotation of epic proportions. And because India is so large, when they rotate, the whole world feels the earth shake. The global silver market is currently in a deficit. We consume more than we mine. That deficit has been filled for years by above-ground stockpiles. But those stockpiles are finite. When a new buyer enters the market with a checkbook worth $6 billion, they wipe out the surplus. They eat the buffer. This explains why the price is acting the way it is. It explains why every dip is bought. It explains why the banks can't smash the price down and keep it down. Every time the price drops in New York or London, Indian buyers see it as a discount. They step in and sweep the floor. They are the put option under the market. The Western banks are trying to play poker, but India is playing hungry hippos. They're just grabbing everything on the table. This 400% spike in imports is the smoking gun. It proves that the price rise isn't speculative froth. It is driven by physical delivery. Paper markets can be manipulated. You can print infinite contracts, but you cannot fake a customs report. You cannot fake 6 billion of physical metal crossing a border. That metal has to exist. It has to be refined, and it has to be shipped. The logistics alone are mind-boggling. We are talking about thousands of tons of silver moving from west to east. This creates a logistical vacuum. If all the available shipping containers and secure transport are booked to move silver to India, there is no capacity left to move silver to New York to cover a short squeeze. The supply chain is being monopolized by the biggest buyer. So when you look at the chart and see the price hitting $94.68, realize that this isn't just a number. It is the result of a bidding war. The West wants to keep the price low to protect the dollar. The East wants to own the metal to build the future. The East has more cash, and right now they have more desperation. India has effectively set a floor under the price. If silver drops, they buy more. If silver rises, they buy more. They are price inelastic because they view silver as essential wealth, not just a trade. This Indian whale is the force that broke the back of the cartel. The banks could handle retail buying. They could handle a little bit of industrial demand. But they cannot handle a sovereign nation-state deciding to corner the market. And India isn't the only one. They are just the loudest one right now. While India is vacuuming up the supply from London, China is doing something even more aggressive. They aren't just buying, they are closing the gates. In the next part of this deep dive, we are going to look at the Shanghai breakout. We have reports that the Shanghai silver price has hit a record of $15 per ounce. The premium over the Western price has hit $11, a record that smashes the previous highs from 2011. But more importantly, we are going to look at the export restrictions. China is the world's factory. They process the silver, and now they are refusing to let it leave the country. India is taking the metal. China is keeping the metal. And the West is left holding the empty bag. The global squeeze is here. It isn't a theory. It is a $6 billion receipt. We have established that the Indian whale is draining the quantity. Now, we need to look at how the Chinese dragon is breaking the price mechanism. While the Western markets were patting themselves on the back for hitting $94, the Shanghai Gold Exchange looked at that number and laughed. We have just received the closing data from the Shanghai session, and the number on the board is $105. In the West, we are still debating if silver can hold $90. In the East, they have already blown past the century mark and are trading at a level that most American analysts said was impossible. But the absolute price isn't even the most terrifying part of this data. The most terrifying part, the part that should make every short seller in New York wake up in a cold sweat, is the premium. The spread between the price of silver in Shanghai and the price in London and New York has just hit a record $11 per ounce. To understand why this is a catastrophe for the banking cartel, you have to look at history. Go back to 2011. That was the year of the legendary silver squeeze. The price went parabolic. Banks were failing. The system was on the edge of collapse. At the absolute peak of that mania, the Shanghai premium reached about $7. $7 was considered systemic failure territory in 2011. Today we are at $11. We are 57% higher than the previous record for market dislocation. The gap has quadrupled in just the last few weeks. This tells us that the current crisis is not just a repeat of 2011. It is significantly worse. It is a deeper, more fundamental fracture in the global financial architecture. When you have an $1 spread, you do not have a global market. You have a broken market. Think about the physics of arbitrage again. If you can buy silver in New York for $94 and sell it in Shanghai for $15, you are making an $11 risk-free profit on every single ounce. That is an 11% return in days. This creates a black hole. Every ounce of silver that is not nailed down, every bar that is not locked in a sovereign vault, is being sucked into this vacuum. It is flowing from the low-price jurisdiction, the United States, to the high-price jurisdiction, China. This is why the COMEX inventories are crashing. The banks are not selling the silver to you. They're selling it to the arbitrageers who are shipping it to Shanghai. The West is being striped of its strategic resources because our paper markets refuse to price reality correctly. The COMEX is trying to tell us that silver is worth $94. The physical reality in the world's factory is telling us it is worth $15. Who is right? Is it the paper traders in Chicago trading leverage and debt? Or is it the industrial manufacturers in China who actually need the metal to build the solar panels that power the world? The physical buyer is always right. And the fact that the premium is expanding tells us that the physical shortage is getting worse, not better. If the market were balancing, the spread would shrink. Supply would flow to China, satisfy the demand, and the price gap would close. But the gap is widening. This means that even with the massive flow of metal moving east, it is not enough. The hunger in China is insatiable. Why? Because China is witnessing a severe physical shortage. The prompt we received explicitly states that these premiums indicate massive domestic demand that cannot be met. This is the nightmare scenario for the green energy transition. China produces over 80% of the world's solar panels. They produce the majority of the world's electric vehicle batteries. These industries run on silver. If there is a shortage in China, it means there is a shortage in the global supply chain of everything from iPhones to Teslas. The $11 premium is the market screaming that the industrial supply chain is breaking. Factories are bidding against each other for scarce material. They are paying $15 not because they want to, but because they have to. This validates the inelasticity thesis we have been pounding the table on for months. When you need silver to finish a product, you pay the price. Period. So, where does this leave the US price? If Shanghai stays at $105, the US price has to rise. It is simple hydrodynamics. Water seeks its own level. Prices seek equilibrium. The US price is being dragged up, kicking and screaming by the Chinese reality. The banks in New York are trying to suppress the price to save their short positions. They're throwing paper at the market to keep it under $95. But every time they smash the price, they just widen the spread. They just make the arbitrage more profitable. They just accelerate the drain of physical metal. They are trapped. If they let the price rise, they go bankrupt on their shorts. If they keep the price low, they lose all their physical inventory to China. They have chosen to lose the inventory. They are sacrificing the nation's silver stockpile to save their quarterly bonuses. But eventually, the inventory runs out. And when the inventory runs out, the paper price becomes irrelevant. The only price that matters is the price you pay to get delivery. And right now, that price is $15. So when you look at your screen and see $94, understand that you are looking at a ghost price. It is a legacy number. It is the price of a contract that might not be honored. The real price, the clearing price for physical molecules, is already in triple digits. China has crossed the Rubicon. They have accepted the new paradigm. This brings us to a terrifying question. If China is paying $15 and they are still short of metal, what are they going to do next? Are they going to just keep buying, or are they going to take more drastic measures? We have reports, and this is where the story gets truly dark, that China is not just buying. They are preparing to close the exit. They are realizing that silver is too valuable to let leave the country. They are realizing that if they control the silver, they control the future of energy and technology. In the next part of this deep dive, we are going to look at the weaponization of silver. We have information regarding export restrictions from China. This is the ultimate roach motel. Silver goes into China, but the government is making sure it never comes out. We are going to analyze why this policy shift essentially corners the global market and forces the rest of the world to beg for scraps. The Shanghai breakout is the signal, the export ban is the lock, the global squeeze isn't coming. It is here. It is trading at $15. And the West is about to find out what happens when you sell your lifeboats to your rival in the middle of a storm. We have watched the Indian whale vacuum up the available supply. We have watched the Shanghai price break out to $105, creating a gravitational pull that is destroying the Western markets. But if you think high prices are the only problem facing the global financial system today, you are missing the endgame. High prices are a signal. What comes next is a lockdown. We have received confirmation that China is quietly enforcing strict export restrictions on silver and silver containing critical minerals. This is the ultimate roach motel strategy. We talked about this concept with the US tariffs, but China has perfected it. Silver checks into China, but it never checks out. To understand why this is happening, you have to stop thinking like a trader and start thinking like a central planner in Beijing. China is the world's factory. They produce the vast majority of the solar panels, the electric vehicles, and the electronic components that the world relies on. These products require silver. For 20 years, the West was happy to sell its silver to China. Let China do the dirty work of manufacturing and then buy back the finished iPhone or solar panel. It was a convenient arrangement. But now the world has changed. Resources are scarce. The mines are empty. So China has made a strategic calculation. They have decided that they will no longer export raw silver. They will not sell you a silver bar. They will not sell you silver grain. If you want silver from China, you have to buy it inside a finished product. You have to buy the solar panel. You have to buy the battery. You have to buy the EV. This is value-added nationalism. It is like Saudi Arabia saying they will no longer export crude oil, but they will happily sell you gasoline at a premium. It forces the rest of the world to remain dependent on their manufacturing base. But here is the dirty secret that makes this export restriction so devastating for the COMEX and the LBMA. China is also a major refiner of silver. Much of the silver mined in Asia and even parts of South America flows through Chinese refineries. If China restricts the export of refined silver bars, they are effectively cutting the supply line to the London vaults. The LBMA relies on global flows to balance its books. If the Chinese flow stops and the data suggests it has stopped, then London is trying to satisfy global demand with a shrinking pool of metal. This explains the squeeze we are seeing in the prompt. The report explicitly states that export restrictions from China have squeezed the global market. This is not an accident. This is economic warfare. China sees the United States trying to reshore its industry. They see the G7 meeting to secure supply chains. They see the US trying to build its own solar factories and battery plants. And China is saying, good luck building those factories without the metal. By hoarding the silver, China is choking off the reindustrialization of the West before it can even begin. They are weaponizing the periodic table. This turns silver into a geopolitical hostage. It means that the price of silver is no longer just about inflation or interest rates. It is about access. If you are a Western manufacturer, you're now facing a terrifying reality. You cannot get silver from China. You cannot get silver from the US Mint because it is closed. You cannot get silver from the dealers because they are rationed. You are entering a world of resource apartheid. Before we discuss the consequences of this trade war, I need to take a brief moment to address something important regarding our community here. We are boring currency. This is the original channel. We are real people doing real research. We spend our nights digging through customs reports, analyzing vault data, and connecting the dots so you don't have to. Unfortunately, we have noticed a wave of copycat channels popping up. They are using the same avatar. They are copying our scripts word for word. They're posting our videos on Twitter and TikTok pretending to be us. I want to be very clear. We have only one channel. It is this one on YouTube. We do not have a Twitter account under a different name. We do not sell crypto on Telegram. We are not asking for your money on WhatsApp. The other people using this avatar are not affiliated with us in any way. We do not take responsibility for their info. They are copycats, and frankly, they are lazy. They are trying to harvest the fruit without planting the tree. We provide this video with a lot of research and only verified info because we respect your time and your intelligence. So, if you appreciate the work we do here, the deep dives, the forensic data, the late nights, please help us protect this community. Go down to the comments section right now and type "staying with the original." Let the algorithm know that you are here for the real analysis, not the cheap imitation. We read every comment and we appreciate your loyalty more than you know. Now back to the export ban. The implications of China locking the gates are profound for the price of silver in the West. If the West cannot import silver from the East, the West must rely entirely on its own production. But as we know, the United States consumes far more silver than it produces. We are a net importer. We rely on Mexico, Peru, and yes, China, to fill the gap. If China exits the chat, the deficit in the United States blows out. This creates a scenario where the price in the US must rise high enough to attract metal from somewhere else. It has to rise high enough to convince someone in Mexico to sell to New York instead of Shanghai. But remember the Shanghai magnet from part 2. Shanghai is paying $15. New York is paying $94. Why would Mexico sell to New York? So New York has to go to $16, has to go to $110. It has to outbid China. This is a bidding war for the remaining calories on the global dinner table. The export restrictions are the final nail in the coffin of the global spot price. We are going to see a fragmented market where silver costs one price in Shanghai, another price in London, and another price in New York. And in that chaos, the physical holder wins because if you hold physical silver, you hold the universal key. Your ounce of silver is valid in Shanghai. It is valid in New York. It is valid in Mumbai. It is the only asset that transcends the borders and the tariffs and the bans. The paper contract is stuck in the jurisdiction where it was issued. The physical coin travels with you. China knows this. That is why they are not exporting bars. They are keeping the wealth within their borders. The weaponization of silver is the phase where the mask comes off. The governments are no longer pretending this is a free market. They are openly fighting for control of the resource. In the next part of this deep dive, we are going to look at the trade war. We have reports of escalating tensions between the US and the EU. We have the Nifty Metal Index in India breaking out to an 11-year high relative to the stock market. This is the signal that the smart money globally is rotating out of financial assets and into commodities. We're going to analyze why this trade war ensures that inflation will not come down. Tariffs, export bans, and supply shocks are inflationary by definition. The Fed can raise rates to 100%, but they cannot print a silver bar to bypass a Chinese export ban. The squeeze is geopolitical, the squeeze is structural, and the squeeze is accelerating. We are heading to part 4, the trade war, the metal index, and the signal that the global equity market is about to price in the commodity supercycle. We have looked at the physical vacuum in India. We have looked at the price explosion in Shanghai. We have looked at the weaponization of exports by China. But there is one more layer to this global puzzle. It is the layer that explains why the smart money is fleeing the banking system and piling into the mining sector with a reckless abandon. It is the return of the trade war. And this time, it isn't just a skirmish. It is a siege. We have received reports that trade tensions between the United States and the European Union are escalating rapidly. The tariffs we discussed in our previous reports, the ones targeting the United Kingdom and Europe, are starting to bite. Why does a trade war matter for the price of silver? Because trade wars are by definition inflationary. For 30 years, the world enjoyed the benefits of globalization. We could mine silver in Mexico, refine it in Switzerland, sell it in London, and use it in a factory in China. It was efficient, it was cheap, but when you start putting up walls, when you start slapping tariffs on imports and banning exports, you destroy that efficiency. You add friction to the system, you add cost. If a European refiner cannot ship silver to the United States without paying a penalty, the price of silver in the United States goes up. It has to. This trade tension is the match that lights the inflationary bonfire. It tells the market that the era of cheap goods is over. We are entering the era of secure goods and security costs money. But the most damning evidence that the global financial elite know what is coming isn't found in a government press release. It is found in the stock market. Specifically, it is found in a chart that almost nobody in the United States pays attention to, but which is currently screaming fire in a crowded theater. I am talking about the Nifty Metal Index. For those who don't follow Asian equity markets, the Nifty is the benchmark stock index of India. It is their S&P 500, and the Nifty Metal Index tracks the major mining and metal producing companies in that economy. Why should you care about Indian mining stocks? Because India is the demand engine of the world right now. As we proved in part 1, they are the ones buying all the physical silver. So if you want to know where the smart money is betting, you look at what the Indian investors are doing, and what they are doing is historic. The Nifty Metal Index is having its best start to a year since 2018. It is exploding higher. But here's the metric that matters. The ratio of the metal index to the general market, the Nifty 50, has just hit its highest level in 11 years.